Hello, everyone, and welcome to our market alert video for today, which is September 6th, 2024. And what we're going to do this week is we're going to look at history and we're going to see how the market behaved when we had an election year, and specifically in the last 3-4 months of the year, because there's some remarkable similarities that I want to share with you. And to help me to do that, I'm going to ask Jordan Roach, our director of our Investment Oversight Committee, to join me. So, Jordan, hi there.
Hey, Ken.
Welcome. So, you've done some research into how the market has behaved over, the last 7 election cycles. And so, can you kind of walk us through a little bit of what your analysis and what your research has shown us?
Sure. Yes. Let me pull up my screen here. And it's been a good, interesting study here. I know we're getting more and more clients calling and asking us, like, what do we expect going forward? Obviously, there's a lot of noise going on with the Fed, but now we got an election. So what I want to do is just a quick study in the last 7 cycles to see if we have patterns or anything we can glean on that help us set expectations of where the market could go into the end of the year. So the first one we're looking at here. This is the COVID year, right? So this is 2020. And obviously that year was a year of a lot of volatility. And that volatility, picked up and we saw that again in the election cycle. So on this chart, I basically have from September 1st of 2020 through the end of the year for the S&P 500, right? Because that's the index that we're using broadly just to track the state of the market. And what we're see here is that September, we had a sell-off, right? Now, historically, September is kind of a bad month seasonally, on average, even absent election years. And we saw this in election year continue. So we saw really two corrections that year, and the market largely trended sideways to early November, right? When election cycle is that first Tuesday kind of November. And then it found its footing, and then it rallied into the end of the year. And ultimately, even though it started off twice there from September to the end of the year, you saw about a 6.51% return if you kind of held all the way through there. So it ended up being an okay year.
And it looks like it kind of started in September. So this was ahead of the election. So there was kind of maybe some increasing uncertainty over who was going to win and which way policy was going to go, which way taxes, et cetera, would go. So there's uncertainty. So there was that sell-off there that you're showing. But once that uncertainty went away, it looks like it really rallied after that.
Yes, that's exactly right. I mean, obviously, that's a COVID year, so you have a bunch of uncertainty. And then I think that year, the election certainly mattered of who could come in with their policies and maybe fix the economic crisis we were in. And so if we just look at what type of losses did the market experience, this is showing percent off high. So that's a drawdown, which is, where the max amount the market was, the distance from there to the bottom of the market at any given point. And so you see in September here, this sell-off, we look at this line to the right, it crossed 8%, went down to 9. So the total loss for that year was about 9% in that September month. And then you had an 8%er that happened again, not shortly after. But again, once markets, were kind of priced in things and we got confirmation of who was going to be in the seat, the market found its footing and it rallied to the end of the year. Right. So what this means is when it's at 0% at the end here, it just says the market reached its high at the end of the year. So that ended up being
Interesting.
okay.
Okay. And
Now,
so
yeah.
what other years have you looked at?
So I went through 16, 12, and really all the way back to 96, just to see with recent history, recent state of the markets, how they were acting. So this is 2016, right? So this year again, there was other noise going on in the background, right? With different relations, with tariffs, all these things. But you see a similar thing in 16, that largely the market up to the election went sideways, if not sold off largely, right? So it sold into it as uncertainty is kind of getting worked out. Markets are trying to get ahead of things. And ultimately, when the dust settles, when confirmations hit, market rallied pretty well. From down at -4% around the election, it ended up being up 3%. So you see basically a 7% rally after the election. So that's a healthy thing. And again, if we look at kind of similar last chart of, well, how much did it sell off at that point? This wasn't as much as COVID, but this one sold off, almost 5%. So it was kind of a normal correction. Probably didn't feel healthy and fun at the time, but about a 5% sell-off that we saw until ultimately we rallied through the end of the year.
And this was from the beginning. So both, all these charts are looking at from the beginning of September, correct? Into the end of the
Yes,
year.
right. Kind of that where we are right now, that September period through the end of the year in an election year. What's going on? Can we see any patterns here?
Yeah,
That's
and
right.
2016 was not as big of a sell-off as the previous chart that you showed, 2020,
Yeah.
but it's still there was a down into the election and then an up afterwards.
Yes. Right.
Okay.
Now this is 2012. Again, 2012, different variables here. Like this one was coming out of a little bit of a Eurozone crisis and some currency, uncertainty with an election year. And so this one again, you'll see it come through all the way into November here, where it kind of bottoms mid-November, is that markets largely sold off, right? So we had a sell into the election, market found its footing, and we rally into the end of the year. And if we put numbers to that, what that looked like is, we crossed to about a 7% sell-off that year. So you crossed the 6% mark down almost to the bottom. And so, that's a 7% and change sell-off. So that's a pretty good one, right? So once we get to 7%, we're getting to almost technically what a correction is. And then ultimately the market found its footing, and recaptured some of that. So that's again the 2012 cycle.
Okay.
Yeah. And then if we just kind of equate, like, let's just say what happened since 96, again, kind of more recent times, more recent election years, more recent market environments, what's going on. So in 2020, if you look at the return on the market itself, it made 6.51% through the end of the year. So September through the end of December. If you looked at the max drawdown, we're seeing a little bit under 10%, so almost a full correction. And the
And by
bottom
max
actually occurred.
and by max drawdown, you're talking about from the beginning of September to where it bottomed out. How much did it go down? So in 2020, that was the 9.6% there, and it bottomed on September 23rd. But you also have October 3rd in
Yeah.
parentheses. What happened there?
That one you had to go through a 9.6 percenter and an 8 percenter. So that 8 percenter hit on October. So that was almost a double sell.
Oh
So you hit
my.
the bottom, it rebounded, sold off another 8, found its footing, and rallied through the end of the year.
Man, COVID had all kinds of gifts for us, didn't
That was a good one. That was a good one. That's right. So you go 2016, a 3.53% return for that 4-month period. And then the actual sell off, it was minus 4.63. It found its footing like right around election day. Right. So November 4th is where it found its footing. That's where the market bottomed and then rallied. You go 2012. Again, that was more of a sideways market, but 1.39%, people will take it. But that's a bigger one, right? So minus 7.67% was the bottom. That's how much the sell-off was. So a little over 7% sell-off. Market bottomed around November 15th and then rallied into the end of the year. So, these first three instances, all those are coming kind of later in the cycle around election time. 2008. Now, again, this is the doozy. So 2008 markets just, fell out in the back part of that year. So from September through December, just that 4-month period, you saw almost a minus 30% decline.
Yes,
Right.
I
So flat
remember that
charts.
one vividly. In fact, in October is when Lehman went under and the floor just fell out from under the market. And so, this was Barack Obama's when he was elected, but I don't think we could say that it had anything to do with Barack Obama. This is entirely because of the bank crisis and what was happening with Lehman, and then all the other banks that were following on after that. It was a terrible time. I remember it. Fortunately, though, with our invest and protect strategy, we were spectators, not participants.
Right.
There's a huge difference between being a spectator to an event like this and being a participant. And fortunately, our strategy helped us to be out during that year and did not experience that 41% drop that happened there.
41% in 4 months, Ken, right? I mean, you remember that way better than I do. I mean, and that is horrible. That's a painful. And so November 30th was where it actually bottomed, and then it kind of went sideways, picked up a little bit of that back, and through the end of the year. But again, 2008 is a different deal. It's an election year, but you have a recession overlaid onto it. And then you go 2004. So that period I didn't show on the graph, but just to kind of see the data behind it, from September through end of the year, almost a 10% return. So it's a pretty healthy back half of the year. But again, there was a 4% correction that occurred.
Hmm.
Right. So we saw that little bit of a sell-off October 22nd. So right before the election.
That was my
2000,
birthday. October
Okay.
October 22nd was my birthday.
Okay.
Yes.
So the market didn't give it, wasn't too bad of a gift there. Minus
If
four.
anybody's wondering, I was 20 years old in 2004 on my birthday there. So if you want to do the math.
Hmm. That's pretty good. And so in 2000 will look closer to 2008. I mean, 2000, well, that was a multi-year decline. That was Y2K.com. I mean, that was really a 2.5 year sell-off. But 2000 was the start of it. And so September through the end of the year, you're down 13%. So that was the start of the sell-off.
Okay.
And I believe in that time there was a triggering event there too.
So stop sharing your screen for a sec here. So let me what do you conclude from all of this? You've looked at all this. What's our takeaway? You know, clients are asking, what's going to happen with the election? What should we do? Should we get out? Should we stay in? What do you conclude from all of that?
It's hard to know anything definitive. I would say history has suggested that, generally speaking, we're going to see volatility probably pick up into the election time. So we're going to see movements day to day and then broadly month to month. It wouldn't be improbable to see sideways to some sort of decline, some sort of corrections. The market's kind of pricing in where we're going to be in November. But then absent, an economic slowdown, absent a recession that starts getting priced in, like we saw in 2008, 2000, or 2000, markets usually find their footing. And then they're going to run up into the end of the year and hopefully, recover some of that or book some nice gains. So that's the
So
question.
it sounds like what you're saying is that if we do get a big drop, unless it's like a Y2K or 2008, where there's a very obvious reason why the market is tanking like it is. But otherwise, if the market does go down 5 or 10%, it's not a reason to panic and sell. It looks like, based on history, that it might actually be a buying opportunity.
I think that's right. I mean, I think that's more common than not that it ends up being a buying opportunity. So that'd be interesting to see where we play out this year.
Yeah. So again, past performance does not guarantee anything, right? It's just interesting to look at. But there is another expression that says that if you don't learn from history, you're doomed to repeat it. So we can take both of those and pick which one we prefer for purposes of how we want to conclude it. But Jordan, thank you for the analysis here. That was
Of
very
course.
interesting. And for those of you watching who are wondering, what our recommendation is based on all this, it's just what Jordan said, and that is that we most likely will get some reduction, some sell-off. It could be anywhere from 5 to 10%. But if it did happen, we look at that not as a reason to panic, because right now we're not in the middle of a recession, we're not in the middle of a credit crisis, we're not in the middle of a dot bomb, we're not in the middle of any of those things. And so therefore, there's no exogenous event that's looking like it's going to cause it to fall off a cliff. And that being the case, we would see a correction of 5 to 10% as a buying opportunity. And if we don't have anything to buy, then stay the course and grit your teeth and play through it, right?
That's exactly right.
All right. Well, thank you, Jordan, for sharing all of that with you. Very interesting analysis. And ladies and gentlemen, thank you for watching this video. I hope it finds you healthy, wealthy, and wise. And we will talk soon.